My concern that I have with interest rates is that if the Federal Reserve raises short-term rates too much and long-term rates are being artificially suppressed by what's going on abroad, then we flatten out the yield curve, which causes a stall in the economy. But what if I'm wrong? What if long-term rates actually do increase as a result of the Fed's moves? What'll that do to mortgage rates? Could it possibly create another housing crash like we had back in 2008? What's your take on that?
Well, there's a lot to your question there. But first of all, interest rates have been too low for too long. That is the problem. And the Fed needs to allow the market to set interest rates. And I believe if the market did set interest rates, they would be much higher than they are today.
Of course. Yeah.
And of course, by the Fed keeping interest rates so artificially low for so long, not just at the long run, and they've suppressed long-term interest rates with their asset buying, the quantitative easing, but also keeping short-term interest rates so low, they've distorted the economy. And what we've had ever since the last financial crisis was not a recovery, but a bubble. And we haven't
artificially created, exactly.
Yeah, we haven't addressed any of the structural problems caused by the last bubble. We simply compounded them with a new bubble. So all the Fed has bought with all this quantitative easing and 0% interest rates, it is a huge speculative bubble. We have inflated our asset prices, and we've gone deeper into debt. But the underlying structure of our economy it's actually gotten worse.
Yeah.
So I think fundamentally we're in worse shape now than on the eve of the last financial crisis, which is why the next financial crisis is going to be much worse.